say first and foremost, we kind of take a step back and say, well, what are the fundamentals of this company's business? Is there still demand for their products? Are they still holding or gaining share in those different markets? And then, we're willing to look through some volatility as it relates to FX. In terms of what companies are saying and what they're doing, you kind of see two schools of thought. I would say many companies, particularly in the consumer space, like Coca-Cola in some of their emerging markets, they try to raise prices in the local markets to offset the impact of FX, so to help mitigate the impact of the FX. And then you see other companies like Nike who are competing against some European companies, and they are not raising prices and hoping to use the strengthening dollar as a way to gain share. So those are kind of the two schools of thought in terms of how they're dealing with the FX volatility. Volatility, if you're willing to look out longer term, can oftentimes be opportunity, and that's one of the things that we've been thinking a lot recently about as it relates to energy. So, when we think about the energy sector, we look at the cost of getting a barrel out of the ground, and the cost of getting a barrel out of the ground right now is above the market price. So unless you think that the players in this industry are going to remain irrational for a sustained longer period of time, price of oil needs to go up. And so in thinking about that, we've been doing a lot of work on the energy space and trying to invest into that volatility and make it work for the portfolio. When we think about the large cap growth portfolio, we're really trying to diversify into different kinds of growth names. And the point of that is that different areas of the portfolio work at different times. And we want that because we want the portfolio overall to be durable through different investment cycles and through an entire investment cycle. So most of the portfolio is what we call the stable bucket. It's more than half of the portfolio right now. It's about 55%. Those are companies that are good quality companies. If we do our stock selection right, they should do a little bit better than their peer group, and the bucket of them should do a little bit better than the market. The cyclical bucket, it's no more than 25% of the portfolio right now. It's about 20. And that bucket are companies that have revenue or profits that are depressed for reasons that we think are fixable. So they're companies that they still have all the characteristics of names that we look for in terms of generating good cash flow and having strong balance sheets and having good businesses. They're holding or gaining market share, but they have something that we think has an inflection point. Right now, energy, I think, fits squarely into that camp of belonging in the cyclical bucket. On the other end of the spectrum is our select bucket, and those names are, they're companies that are going after big investable markets. Oftentimes they look really expensive because they're investing all of their profits back in their business. They have a nice contribution to the portfolio. They've generally been about half of the outperformance in the portfolio has come from that bucket, but they also tend to be more volatile. So we want to limit the size. We want them in the portfolio, but we want to limit the size of them in the portfolio. Those are names like Amazon, some of the internet names, and some of the biotech names. So that's how we think about diversifying across the three buckets. So in terms of contributors to the portfolio, healthcare has been a nice contributor. It was a good contributor in 2014, and that's continued in the first quarter of 2015. In terms of detractors, energy. We've been adding gradually since the second half of 2014 to our energy weighting, and we think that we're well positioned to benefit from an upturn in energy prices over the coming quarters, but that sector hasn't turned yet, and so that's been a detractor in performance. The question to be asking ourselves is, how strong is the U.S. economy? And that's really where we've been spending most of our time, is thinking about, what's the health of the U.S. economy? What's the health of our portfolio companies? What's the health of companies that we're looking at? Where might there be inefficiencies or short-term dislocations in price, which might help us add to portfolio companies or add to a new position. So generally we feel pretty good about the U.S. If you asked me, what I was worried about or what keeps me up at night, I think it's outside the U.S. and it's not so much Europe as in some of the emerging markets. In the emerging markets, they've been such a nice contributor to growth for many large cap companies, multinational companies, over the last couple years. And the absence of that is not really clear. It's not exactly clear how companies are going to make up that shortfall, or how some of those dislocations are going to affect some of these companies over the coming quarters. So that is something that we're spending some time thinking about.